Hello, my name is Sofiia Kafka. I am professor in the Department of Management and Business Administration in Vasyl Stefanyk Carpathian National University. In this lecture, we will explore the specifics of startup financing and its legal aspects. This lecture is a part of NanoBioTech Nexus initiative and is supported by European Institute of Innovation and Technology, Raw Materials, and the European Union. The views expressed are solely those of the authors. Successful creation and growth of a startup require a well-designed financial strategy because financing is a lifeblood that supplies the business idea with resources at every stage, from prototype to scaling. However, financing startup means choosing the right source of funds that fits the startup's, business model, risk level, stage of development, value proposition. How and when a startup raises capital affects not only its survival, but also its future ownership structure, growth strategy, control our decision making. Okay, imagine this. Your team has built a product, you already have fast users, but then it goes quiet. You need money. The question is not where to get it, but what exactly do we give in exchange for the money? Another main questions, who are the players? They are investor and founder. An investor looks at three things: the team, the market, and transactions. If you show a clear path to growth, a clean cap table, and protected IP, you are interesting. The founder is the architect of the deal. Their task is to prepare a pitch deck and a financial model and explain what the money will be used for and what it will unlock. Financing is not only cash. It's also investor trust, a professional network, and responsibility for commitment to partners, team, and the state. Use this slide as a map of places to look for startup money. We move from top to the bottom, from the simplest to the more demanded sources. The first source is bootstrapping or self-financing. Your savings and your profit from first sales are the main sources. The pluses of this kind of financing are full control and spending discipline. Minuses, limited growth speeds, and etc. This kind of financing is best for idea, prototype, and first customers. The next is accelerator and incubators. You get mentoring, community, access to partners, and seed capital. Next is 3F and business angels, friends, family, and private investors. Flexible small checks at early stages when team and vision matter most. Venture capital and private equity. Venture capital come when you show user growth, revenue, and repeatable sales. They invest for equity and expect fast scaling. Private equity for later stages will be a proven model and stable cash flows. Next, grants. Non-repayable funds with clear goals. For example, innovations, climate or sector programs. Advantages is no dilution. Requirements are competitive section, deadlines, and results reporting. Bank financing, loans or credit with call rate or guarantees then when you already have predictable cash flow. Good for working capital, equipment, and export contracts. Think of this as a financing staircase. Start with bootstrapping, add an accelerator or angels, search for grants in parallel, then use venture capital for scaling, and when cash flows are stable, then work with banks. Choose the sources that fits your stage, capital needs, and willingness to share control. Financing happens step by step. The stage of the project, the level of risk, the capital need, and the product's readiness for the market all matter. Each stage has its own goal, typical sources of money, and typical company valuation. Knowing these rules helps you plan fundraising. The main terms that we will use in this part of our lecture are MPV, PMF, MRR or ARR, valuation, etc. MVP, minimum viable product, the simplest version that users can test. PMF, product market fit, the product meets a clear market need. Monthly annual recurring revenue are MRR and ARR. Valuation is the market value of the company before investment. The first stage of financing is pre-seed. Idea or concept only are available. The startup looks for first sources: personal savings, support from friends or family, small grants, incubators. The main goals in this stage are: build the team, run first validation, decide if the idea is worth pursuing. The next stage is seed. An MVP appears and early users give feedback. Demand and the business model are tested. The main investors are business angels and the first venture capital funds. And the main goals in this stage of financing are confirm demand, show early metrics, and path to revenue. The third stage is Series A. The company reaches PMF and has steadily early sales. It prepares to scale. Investors are venture capital funds, and the main goals are scale channels, strengthen the team, and prove unit economic. The fourth stage is Series B plus or later rounds. It may be active scaling. The company enters new markets and build marketing, hiring, and IT infrastructure. Investors are large venture capital funds, corporate investors, sometimes private equity. The main goals of this stage are fast but efficient growth, international expansion, etc. The last but not the least public stage, IPO or initial public offering. The company lists its shares on a stock exchange. Investors are institutional players, banks, pension funds, public investors, etc. Different stages require different money resources and have different investor expectations. A successful startup shows progress from idea to sales, from MVP to scaling. You cannot move to the next round without the key results of the current one, for example, PMF before Series S. Risk and valuation change the deal structure, so prepare a clear pitch deck and financial model and choose the source, the first, your stage, and your willingness to share control. Before meeting investors, align on the key numbers below. These metrics give a clear picture of your growth, efficiency, and runway. Growth metrics are MRR, ARR, DAO, and MAU. MRR is monthly recurring revenue. ARR is annual recurring revenue. DAO is daily active users. MAU is monthly active users. These are the first numbers investors check. They show user growth and revenue momentum. For example, if MEO grows 15% per month and MRR grows 20% per month, the business looks healthy. Next is unit economics. The main metrics are LTV and CAC. LTV, lifetime value, shows how much revenue one customer brings over time. CAC, customer acquisition cost, shows how much you spend to get one customer. The rule of thumb is LTV should be at least 3 multiply CAC. Investor question is, what is your LTV CAC ratio? How much does customer cost and how much do they bring in total? The next ratio is retention rate and churn rate. Retention is the share of users who stay after the first experience. Churn is the share of users who leave. High retention means the product solves a real problem. Investor thoughts. If users don't return, the product does not create enough value. The next metrics are burn rate and runway. Burn rate, how much cash the startup spends per month. Runway is how many months of cash are left at the current burn. For example, burn is 50,000 per month. Cash is 300,000. So runway is 6 months. 300,000 divided to 50,000 per month. The next ratio is gross profit margin. Share of revenue left after direct cost of goods sold. Higher margin is the best profitability and easier scaling. The next is a team that knows its numbers. Not a formal metric, but critical. Investors expect fast, clear answer about revenue, retention, cost, and scenarios. They could ask you, what is your MRR? How is retention trending? How long is your runway? Slow or vague answer are a red flag. If you show growth, healthy unit economics, satisfied users, controlled spending, and a team that knows its numbers, you have a strong chance to raise investment. This is the language investor speaks. On this slide are the core metrics every founder should know when raising investment or measuring performance. They are short, clear definition with simple formulas and examples. First, retention rate. This is the percentage of users or customers who stay active over a period, month, quarter, year, etc. Next, churn rate, the percentage who stop using the product in this period. Why it matters? High retention means real value. High churn is a worrying thing. The formula is retention is active users at period divided to users at period start multiply 100%. Churn is users lost during period divided to users at period start multiply 100%. For example, start with 1,000 users. 150 are still active after a month. Retention is 85%. Churn is 15%. Next is burn rate. Cash the company spends per month to operate. For example, payroll plus marketing plus tools minus monthly revenue is 50,000 burn. Runway. How many months of cash are left at the current burn rate? The formula is runway is cash on hand divided monthly burn. For example, 300,000 cash divided to 50,000 burn is 6 months of runway. Burn rate plus runway together show both speed of spending and time left before money runs out, and they are key for planning a fundraise. The next is MRR, monthly recurring revenue, predictable subscription revenue per month. For example, 1,000 subscribers multiplied to $20 per month is 20,000 MRR. Annual recurring revenue, ARR, predictable subscriptions revenue per year. Formula is ARR is MRR multiplied 12 months is 20,000 multiplied 12 is 204,000 ARR. The next financial metrics are DAU and MAU, daily monthly active users. Unique users active in a day or in a month. The DAU and MAU ratio shows strictness. For example, 25 users active in one for 4 days. LTV, customer lifetime value, is the next financial matrix. Total revenue expected from the one customer over the whole relationships. Simple approach. LTV is average monthly revenue per customer multiply gross margin multiply expected months retained. CAC, customer acquisition cost, is cost to get one new customer. Formula of CAC is sales plus marketing spent in period divided number of a new customer. The rule of thumb is LTV should be bigger than 3 multiply CAC. The next financial metric is gross profit margin. Share of revenue left after direct cost of goods sold. Formula of gross profit margin is revenue minus cost of goods sold divided to revenue multiply 100%. These metrics from a common language with investor: growth, MRR, ARR, DAU, MAU, efficiency, LTV, CAC margin, and runway, burn and cash. The next logical step after understanding your funding needs is to choose the jurisdiction for registering the startup, because it determines access to capital markets, tax incentives, and protection of intellectual property. Even the best financial plans lose value if legal issues are ignored. The legal structure of a startup defines who owns the idea and the product, how equity is split among the founders, who is liable and in what form, where the company operates and which law governs it, who and how to raise investment, legal and safety. In this blog, we will cover what legal forms of startup can choose, how to pick the right jurisdiction, key terms, cap table, vesting, non-disclosure agreement, IP assignment, how founders structure their relationships, rules, equity, decision-making, how to prepare for investment from a legal point of view. Legal guidelines is not only protection, it is also a real asset for investors. Investors back only investment-ready startups. Proper legal structuring is a key signal. What makes a startup investment ready? No investor will put money into something vague or doubtful. They look for clear signs that this is a solid, well-structured project with real growth potential. Let's review those things. The first, proper market demand. Is there a real need for the product? The main proof points are first users, signed pilot contract, or an active customer base. Early revenue or clear use metrics, for example, DAO-MAO. Technology has been tested. Intellectual property rights are documented. This shows the team moved beyond an idea and has tractions. Second, strong commit team. Founders have relevant experience or past product win. Full-time focus on the project. Founders own money is invested. Skin in the game. Investor view the back of team as much as the idea. Third, clean, rational cap table. Equity split among founders is reasonable. An employee stock ownership plan ESOP pool is reserved to motivate talent. It's clear that what portion goes to investor, team and future rounds. The red flag is overvalued founders or a messy cap table. The fourth, proper legal structure. Company registered in an investor-friendly jurisdiction such as United Kingdom Limited or Delaware C Corp, bank accounts in place, ability to sign contracts, international IP assets protected, etc. The fifth is external validation, backed by an accelerator or support program, for example, Startup Wise Guys, etc. Next is transparency and reputation. Team has completed Know Your Customer KYC check. Documents confirm identity, source of funds and compliance. Crucial for international investors, grants markets and fund. Being investment ready is not only about innovation. It's about structure, trust and responsibility. Even a brilliant idea won't raise capital if everything around it is chaotic. Your company's legal home is not a formality. It signals to investors how easy it will be to invest, repatriate profit, sign deals, or exit in the future. Let's see the United States. It's the most popular for global startups. Delaware incorporation takes a few days and is relatively low cost. Legal and banking infrastructure is designed for venture capital. Investors know this system well and invest more readily. A strong choice if you target a global market. The European Union, strong public support. Companies set up can be fast, but banking can be bureaucratic in some countries. Venture capital might be harder than in the United States due to a stricter regulating. Powerful grant programs, for example, Horizon Europe, IT initiatives, supported innovation and sustainability. The United Kingdom, investors' tax incentives, often lower taxes and many United European states. Seed Enterprise Investment Scheme or Enterprise Investment Scheme offer tax relief to investors backing startups. Many experienced law firms for startup deals. Ukraine, convenient for starting, harder for scaling. Fast, simple, incorporation and moderate taxes. Raising foreign capital is difficult if the company is only Ukrainian. Fast products focused on the domestic market. Jurisdictions is not just convenience. It is a key to financing. If you aim for global growth, consider an international structure, for example, Ukrainian R&D plus United States or United Kingdom holding company. Let's see what is a cap table. A capitalization table list shows who owns shares, founders, investors, employees, advisors, the type of share, common or preferred, each person's ownership percentage today, how ownership changed after new rounds, dilution. It is a legally important document and standard part of investor due diligence. How ownership typically evolves by stage, illustrated in cap table. A clear, well-planned cap table shows transparency and discipline. A messy or overloaded cap table, unclear split, inactive holders is a red flag and can kill a deal. How to split equity fairly among co-founders. At the start, everyone is friends. Once money, shares, and deal appears, unclear ownership can break even the best team. Agree early before investors. First is equal split. For example, everyone gets the same share. Risk is later effort may be unequal. For example, both have 50% but only one works full-time. Second, contribution-based. Shares reflect time, cash, ideas and resources contributed. Pluses feels fair. Minuses, scoring inputs can be subjective. Third, result-based. Allocated after milestones, MVP, first customers, revenue. Works when the team has already delivered and you can measure outcomes. Fourth, rule and responsibility based. Split the key rules, CEO, STO, SPO, etc. and expected workload impact. Fifth, dynamic model. Share change over time with equity, effectiveness and duration. Equity is not only about percentage, it is about trust, responsibility, long-term commitment. Before deciding, consider the full picture. Skills and contributions. What has each founder already delivered? What expertise, assets, or resources do they bring? Time commitment. Who is full-time and who is part-time? Equity should reflect actual efforts. Financial input. How much personal cash has each founder invested? Network and trust. Who bring keys, partners, customers or investors? Rules and next. Not only past work, but who will own which function going forward? Risk tolerance. Who is ready to live with startup uncertainty? Vesting terms. Use vesting so equity is earned over time. Exit strategy. How and when might forces sell shares or scale the company? These shape control and motivation. Legal implication. Put equity in writing. Founders agreement. By law, shareholders agreement. Psychological factors. Motivation, stability and ability to handle conflict matter. Opportunity cost. What did each person give up? Job, salary, other project. A fair split is a planned, documented decision that aligns value, responsibilities, and strategy. So full equity keeps the team together and prepares the startup for growth. How to turn an idea into an official business in Ukraine? Registering a startup is the first formal step toward investors, contracts, and scaling. Here are the key steps. Choosing a legal form. The most common are limited liability company, LCC, LLC, or individual entrepreneur. Several founders or outside investment. Limited liability company. Solo early stage is suitable for individual entrepreneur. Next, register the company. Do it online via DIA or with a state registrar. Prepare the charter, founding minutes, founder details, and list of classification of types of economic activity codes. Open a bank account. You need it to contract, receive payments, and operate. Pick a bank with business startup friendly terms. Register for taxes. Choose a regime that fits your model. Single tax, VAT, VAT, value added tax, or the general system. Obtain license permits if required. Check sector rules, for example, health, education, fintech, or certain e-commerce activities. Protect intellectual property. Register trademarks, copyrights, and patents. Sign in intellectual property assignment agreement so the company owns the technology. It is not difficult, but details matter. Set it up correctly once and then you are ready to raise investment, apply for grant, and join accelerators. So, let's decide. Choosing the right form for a startup, individual entrepreneur, or limited liability company. The legal form affects liability, taxes, partner, flexibility, and investor appeal. Here is a clear comparison. Owner, individual entrepreneur, one person is both owner and manager. Limited liability company, one or several owners, easy to bring in partners, investors. Management, individual entrepreneur, you manage everything yourself. Simple, but all decisions on you. Limited liability company can have a director, general meeting, even supervising board, more flexibility and role sharing. Liability, individual entrepreneur, unlimited personal liability. Your personal assets are at risk. Liability limited company, to contribute capital safer. Share capital, individual entrepreneur, none. Stated share capital required, no fixed minimum set at registration. Taking profit out, individual entrepreneur, straightforward and withdraw. Limited liability company, profits are paid as dividends after period choose at owner's decision. Closing the business. Individual entrepreneur can be closed only in 24 hours. Limited liability company, formal liquidation procedure is required. Working solo and want speed and simplicity. Start with individual entrepreneur. Expect partners, investment or scaling, form and liability limited company from the start. Investors prefer it. So the main steps to register an individual entrepreneur in Ukraine are: first, choose classification of type economic activity. Select your official activity code, for example, IT services, marketing, consultation, productation, etc. This code defines what you are allowed to do. Next is pick a tax regime. Choose a general or simplified taxation. For small startups, the single tax group 3 is common because reporting is simple. Third, prepare documents. Fill in the online application and attach scan if your passport and tax number. You can do this via DIA or offline at Service Center. Submit the application. Set everything online in a minute through DIA or file with a stage register offline. Get the EDR extract. After approval, you receive an extract from the United States Register, EDR. This confirms you are a registered entrepreneur and can operate officially. Becoming an individual entrepreneur today is quick, free, and fully online. Main tips are: consult a specialist, review tax rules for your chosen regime, and follow all deadlines and legal requirements. On this slide, you can see the main documents to submit for individual entrepreneur registration. The main of them are core documents, application for state registration. In the application, you may also request single taxpayer status or value-added tax registration if business needs it. Attachment of the application when filling in person, copy of passport, copy of tax identification number. If the person is under 18 but has the right to do business, it is required a written consent from parents. Agreement declaration if a family farm is being created. So you can do it online via DIA, no extra papers you need, or in person from registrar. Notarized copies or originals may be required. There are two options: online via DIA or offline via state registration or a notary. Both are official. They differ in speed and convenience. Register online DIA, fastest. Open the DIA app or go to dia.gov.ua. Sign in with an e-signature from Private Bank ID. Choose Open an individual entrepreneur. Enter personal data, address and contact. Select classification of type of economic activity code and your tax regime. Sign the application digitally and done. After submission, the system registers you automatically and sends the ERD extract to your email. The processing time up to 24 hours. Costs are free. Register office or notary. Apply at register office, service center or through a notary. Prepare passport, tax identification number and the application. Documents are proceed and within a few days you receive confirmation. Suitable if you don't have an e-signature or prefer in-person service. Individual entrepreneur registration is simply for most startups, especially student teams. The online DIA route is the quickest, fully official and free. The main steps to register and limited liability company in Ukraine are: first, choose the company name. It must be unique and meet legal rules. Second, select activity types, classification of type of economic activity code. Third, set the legal address of the company's registered location. Fourth, decide the amount of share capital. Next, prepare funding documents, charter, article of association, main governing document, founder resolution to create the liability limited company, ownership split, who owns which shares of the capital. File the application for state registration registration with the register. Choose a tax regime, open a bank account, obtain the ERD extract confirmation of registration. On this slide, I'll explain the documents you need to register a limited liability company in Ukraine. First, the application for state registration. This is the main form. In it, you can also request value-added tax registration, simplified tax regime, or non-profit status if relevant. Second, the founder's decision, minutes or written resolution, confirmation, the company name, capital, and manager. Third, the charter, the company's rules. If you use the model charter, say so in the application. Fourth, proof of legal address, for example, a lease or utility bill. Fifth, ID documents, a passport or ID card. For foreigners, documents must be legalized or apostolized. Sixth, a power of attorney if a representative submits documents on your behalf. Seventh, a bank receipt or balance sheet, only for registration or liquidation cases. The workflow is simple. Prepare the decision and charter, secure the address, fill the application, attach ID and POR if needed, then submit and receive your registration number. Check names and addresses carefully and keep copies of everything. So, preparing the founding documents is one of the first tasks when creating and registering a company as a legal entity. To simplify this process, the law of Ukraine introduced the option to establish and operate a legal entity using a model charter. At present in Ukraine, only a limited liability company may operate on the basis of model charter as its founding documents. Unlike registering in Ukraine, setting up company abroad is especially relevant if you target international markets or plan to raise foreign investment. The main key steps are: choose the country, consider reputation, political stability, taxes, rules for non-residents. Pick up a legal form, limited liability company, limited company in the UK, etc. File incorporation documents, unique name, registered address, local agent if you require. Open a bank account, ideally in the same country or another with a reliable banking system. Obtain license if your sector is regulated, fintech, health, logistics, etc. Protect IP, trademarks, copyrights, patents, etc. What to check before choosing the country? How credible is the jurisdiction for partners and customers? Do founders or team members live there, help with banking and compliance? Are there tax initiatives for IT or startups? How easy is it for non-resident to open bank account? Can you reduce cost via remote registration or virtual office? The answers on these questions can you help to decide and to choose the country for foreign jurisdiction registration of your startup. Registering abroad can unlock scaling, investment and tax optimization, but it is require careful legal analysis and professional support. Key selection criteria are: level of startup supports are government policy, accelerators, grants, tax initiative. Are the stage or large corporates active building the ecosystem? Do agencies like Startup Estonia or Entrepreneur Singapore operate there? business environment requires simplicity, legal stability, speed of incorporation, access to banking, tech infrastructure, and venture capital. Corporate tax rate, double taxation, and access to global markets. Best countries for launching are United Kingdom, if the company set up, access to European Union, United States markets, strong venture capital. Switzerland, high trust, stability, advanced IT infrastructure. Ireland, attractive 12.5% corporate tax, major hub for tech. Portugal, startup visas, lower cost government support. Singapore, global financial center, top business ranking. Hong Kong, simple to do business, gateway to Asia. United States of America, world's strongest venture ecosystem. Successful startup registration is not just a bureaucracy. It is a key strategic step that shapes future funding, partnership, market access, and intellectual property protection. In Ukraine, you can use traditional forms such as limited liability company or individual entrepreneur or a simplified model charter, which speeds up market entry. A legal entity gives more options for saving investment, explaining the team, and responsible governance. For international expansion, choose a jurisdiction with affordable taxes, simple incorporation, and strong startup ecosystem. Select the legal form that fits your startup goals. Analyze the tax regime, banking system, and investor preferences. Prepare documents according to the rules of the chosen jurisdiction, Ukrainian or foreign. Protect intellectual property from the very beginning. The right start determines scaling flexibility, legal safety, and investment attractiveness. I wish you good luck. Thank you.